Hello, I'm Moira O'Neill for Focus IR. I'm here today with Jamie Constable, Market Strategist at Singer Capital Markets, and we're going to talk about his report on the bond and equity markets. Welcome, Jamie.
Hi there.
So, your report's divided really between bonds the peak and equities the crash. Shall we start with bonds? Is the bull market in bonds over?
We very much think so, yes. You had this exceptional period of, well, it looks like it's 35 years of bond yields falling. Quite amazing, over a generation. Maybe that's two. I don't know I'm not sure what the definition of a generation is, but for me, that's kind of almost two generations. But so we had Volcker, who basically defeated inflation back in the late 70s. And since then, you've had bond yields, looking at the US 10-year, which is the best measure, falling apace. But that bond market is now well and truly over. We've seen bond yields pick back up. You've seen both in the US, but also in the UK, of course. And that has very much made a big change to the markets. Why have those bond yields moved up? Well, you had inflation, interest rates, and interest rates moving up as well.
Yeah, and of course, bond yields going up because the prices are going down, aren't they? I always find bonds very confusing in that respect. So moving on to equities, they've actually outperformed bonds this year. And our AI, artificial intelligence, is getting a lot of equity investors very excited. So how excited should they be, Jamie?
Well, AI is clearly an exciting development. If we go back to 2000, showing my age here, when we had the tech bubble, as it was called back then, we got very excited about technology then. And the big phrase that was used there is you want to invest in the shovels, i.e. the people who are providing the benefits to companies rather than the gold rush. Technology is very good at getting euphoric when you get new technology coming through. So you get the energy adoption cycle. I would say we're probably a little bit in the euphoria phase of technology at the moment. If you look at NVIDIA's rating, NVIDIA is a brilliant company. Let's be honest, look what it's done. It was a games technology chip company, but it's taken that technology and driven it on. But now we have to look at valuations. If you look at valuations, obviously it's on pretty high valuation now, but it's a long-term winner from what's happening. So we have this euphoria, and then we can have that kind of disappointment where the markets, investors look for where are the earnings coming from this. Now, AI, I think, it actually could be a big positive for the UK. Why could it be a big positive for the UK? Well, 80% of the UK economy is services. There's a lot made of manufacturing, but unfortunately, manufacturing is only 10% of the UK economy now. 80% is services. Where will AI have the biggest benefit? It's going to make people more productive. You can automate tasks. You can bring in data, for example, and automate bringing that data in. And you can take the drudgery out of a lot of tasks to make more people more productive, and keep using the word productive, but do more productive tasks. What does that do? Well, it's great for the economy because we've been yearning for an increase in productivity in the UK economy for years now. This could help provide it. Maybe you think about lawyers drafting documents, all that kind of everything like that, which we're good at as the economy. We could see AI benefiting the UK. So yes, we should be excited about it. What should you look for is companies that will benefit from its usage, as well as companies that can sell AI applications into companies so they can do that. That's what the investor should be looking for.
Great. So we all need to keep an eye out and see what we're experiencing ourselves in our daily lives as well, I suspect. So you mentioned UK. I have to ask, UK equities, are they offering value at the moment? They've not been so popular for a long time, but what do you think?
Well, obviously, if you look at the US and what's happened there, obviously the big tech companies are there, and we'd have a shortage of those in the UK. But on the UK, we have to look at valuation. If we look at valuation on the UK now, if you look at the FTSE All Share, 21% of the FTSE All Share is on a single-digit PE. I'll just repeat that, a single-digit PE for over 20% of the All Share. If you look at AIM, and obviously AIM's always known, there's always lots of loss-making companies, et cetera, et cetera. On AIM, it's 17, 18% of A is on a single digit PE. If you look globally, the UK is arguably one of the cheapest markets in the world. Now let's look at what's happening on M&A. Are UK companies being taken over? Yes. I mean, we're seeing each week another company disappears. So the UK market is very cheap, we believe, and cannot be ignored. What has driven the UK to that valuation? Hesitate to mention Brexit, but Brexit almost was kind of the start of that undervaluation starting. And why is that? Markets hate uncertainty. Uncertainty, not Brexit per se, but the uncertainty of that drove investors away from the UK. If you roll back the years, pension funds obviously have been selling equities for years because they've been putting their money into bonds because of the maturity of those pension schemes and the final salary pension schemes. But if we look as at today, 56% of the UK market is now owned by overseas investors. Those pension funds we talk about, the defined benefit pension schemes, they're down to about 3% in UK equities. There's not much more to be sold. And the overseas investor does like owning the UK because they own 56% of it. What we need in the UK market now are inflows into UK equity funds. What we've seen through the summer, and if you look at some of the statistics on this, the outflows seem to have fallen off and faded. There are still some out there. Liquidity works in both ways. Liquidity on the downside, obviously the selling has driven the market to these low valuation levels. Inflows start coming back in again, then the market can move up very quickly. And we've seen that historically.
Okay, so sounds like lots of opportunity there in the UK as you see it. Now, I can't talk about equities without mentioning China. Everybody feels it's very important. Do you? What's happening to the economy there? Should we be worried or excited?
China's very interesting. I mean, of course, China went through the Industrial Revolution at 1,000,000 miles an hour. Arguably, they've done that. The Industrial Revolution is finished. They've got an advanced economy there in terms of manufacturing. What they need to do now is promote what we are in a Western economy is driven by services and consumption. And there seems to be a slight ideological problem within China, its whole regime of profits. You've seen that, remember the online learning companies, suddenly they were made non-profit overnight. So they've got a problem there. The big problem though, is that actual Chinese population now is shrinking. From that years of growth, the Chinese population is now shrinking. In about 2020, the death rate started to exceed the birth rate. It's very hard, if you look back economically, for an economy to grow at extreme growth rates if your economy is shrinking, which is why they need to drive consumption. If we add on top of that, reshoring, nearshoring, terms I'm sure everyone's heard, which is where you've got this trade war going on almost, haven't you, between the West and China, led by the US, and companies are taking their manufacturing production out of China and bringing it back to the US or to North America because they want to be in the same continent, or European companies are bringing it back to Europe, etc., etc. That was obviously accentuated by the supply chain problems we had during the pandemic. The supply chains were so long that people couldn't get their goods back in, and they ran out, and hence we had that inflation problem. That creates problems for China because, of course, that whole manufacturing side of their economy is shrinking. The population is shrinking. They've got 20 to 25% youth unemployment, depending how you measure it.
Gosh, that's huge.
That's all known.
Yes.
Huge.
Yeah.
That's all known. So China is not actually delivering growth for the global economy now. So looking forward, we're not going to see a bad impact from China, i.e. growth falling off from China hitting the global economy. Were we expecting China to come back and grow strongly? I think they forecast 5% for this year. The Chinese, we're down to about 4% from independent forecasters now. So we're not losing anything from China. So I don't think we should be worried about China, but it's important because we shouldn't expect China to come back and be that big growth engine going forward for the global economy. That period's come to an end.
Okay. So I'm taking from that there are lots of opportunities at home within the global economy that you still need to keep tabs on. Jamie, it's been absolutely great to hear where you think the opportunities are. I'm sure investors will be inspired, and thank you very much for sharing your insights with Focus IR.